So this is class 7, and we are going to continue our discussion from the prior class where we talked about term versus permanent insurance and the debate. What we want to do here is really flesh out your answer on that question and get it well organized, not just for this class and exam, but mainly so you truly understand this debate. It's a very heated debate in the insurance industry, so you really want to understand it. And then hopefully we'll get a little bit into annuities today and see how far we can get. Annuities should be interesting because it's the topic for your paper 1. And so you've already seen some of these issues, so hopefully some of it will be reviewed. So we're on page 25 of the notes. Remember what I did here is I went out and found a web page. I actually used A.O. Williams' web page for Primerica, where they had a list of reasons you should buy term and invest the difference. And then I went to that textbook, a very biased textbook toward permanent insurance, and they gave the arguments for why you should buy permanent. And that textbook didn't say, here's the reason you should buy term, and here's the reason to buy permanent. They simply gave the reasons to buy permanent. So very biased book. So I just took their arguments and I gave them as is. You'll see a few editorial comments. So when you see an indentation without the number, that's me putting an editorial comment in there. But the list itself is exactly the list that they had on their website. So what you might want to do, these are in the notes, page 25. You can copy and paste this, maybe in a Word document, and listen to this video and then really flesh out each one of these. Make sure you fully understand them so you can put this into your own words for the exam, and also make sure you just understand there's more to this than just the titles in the 1, 2, 3, 4, 5. So let's start with the very first one, which says complete separation of insurance from the savings element. So if you know, permanent insurance is insurance plus a cash value, so it's all intertwined. We know we talked about universal life insurance and variable universal life. When you see that word universal, the insurance company itself has started separating the insurance from the savings element within the product. But when this was written, the main competitor to term insurance was whole life, where you could not separate. If you bought the whole life, you had to buy the insurance and the savings element. Now, I remember several years ago, I was in the UTSA library and I found a very, very old book on the life insurance industry, and it was extremely negative on this particular point. And they said, why would you do this with any other transaction what the life insurance industry is having you do, where they're forcing you to buy insurance and a savings product combined, bundled in one product. And they actually said, what if you did this with auto insurance? So the insurance company says, your auto insurance is $100 a month, but we're going to charge you $180 a month. And you say, well, why in the world would you do that? Well, we'll take the $80 and we'll invest it for you. That way, if you never have an accident, at least you'll get something out of the policy. And then you say, well, but if I have an accident, then I guess you'll pay for to fix my car, plus you'll give me whatever I saved up. And they say, no, if you have an accident, we'll first spend whatever money you saved up to pay for the accident, and then anything that what you have saved up doesn't cover, we'll cover the rest. You think, well, wait a minute. If I save the money and have an accident, you're going to use my own money to pay me to fix my car? That doesn't make sense. But essentially, and he was trying to make, I thought it was an interesting way to say it. You really would not do whole life insurance with any other product, paying extra money and they set it aside to save it for you. And that's what this first bullet means. Why combine insurance and savings into one product so you have no control? You have to do both. One might be great, one might be horrible, but you can't control that. They're in one product. You have to do both. So the buy term, invest in difference says it's better. Buy insurance, invest for retirement. Don't combine those both into one product. The second argument we've already seen when I show you how you price, how the premiums look for different insurance. And term insurance is much cheaper when you are young. So when you're young, you buy term insurance, especially level term, which is what Primerica was buying, level term. So you maybe buy 20-year level term, and the premiums will be very low for 20 years, which is when you need it. Remember, you're buying life insurance as a perfect hedge against premature death, and it's a protection against losing human capital. So both of those, it's a low risk when you're young, so that makes the insurance very cheap, but your human capital is the largest, so that's when you most need the insurance. And so that's actually, I'll go and combine these for you. So part of your organization is figure out how to do this list better. I gave you the list exactly from their website, but I would combine number 2 and number 5. Number 2 is the lowest cost insurance when you're young, and if you buy that, then you're front loading the insurance to when you need it. When you have the dependents, and you really should add to your notes number 5, it's not just having dependents, but pull from what you did in paper 1. It's also when your human capital is the largest. It's when you most need protection. They did not talk about human capital on their web page. They just talk about dependents. But I would add a number 5. It's both when you have dependents, and it's also when your human capital is the greatest. So definitely I would put number 2 and number 3 together. Now number 3 follows from number 2, because in number 3 what they're saying is, since insurance is so cheap when you're young, you'll have a lot more money to invest, and so you're buying the cheap insurance, and now you can invest, and you now have control of your investment part of the because it's your money, you're not giving it to the life insurance company, so you have more control, and that's number 4. So number 3 and number 4 to go together. You have more dollars to invest, and you have more control of your investment program. Now we'll talk at the end how universal life and variable universal life are really changing this. So within the permanent insurance, they're now allowing you to separate. They're allowing you to put your money in where you want to put it. So some of these arguments are getting a little bit weaker. The problem with number 3, and we'll talk about this when we talk about the arguments for permanent, is that a lot of people, they bought term, but they did not invest the difference. So they were in a lot of trouble when they turned 50, 55. At least if they had bought the whole life insurance, at least they would have had something. And we'll talk about that with permanent insurance. I'm not saying you need to give the arguments against while you're doing the arguments for. So maybe you need to move this argument into the pro argument for permanent, and I'll show you where that will go. On the permanent insurance, we have an argument called forced savings. And so when you have forced savings, you get around this problem. And then we'll have to address the issue that universal life somewhat negates that forced savings. So you can see it gets complicated, because that's the argument, but then there's this counter argument, then there's this counter argument to the counter argument. So just take copious notes and then think about organizing it. And so if you buy term and you invest the difference and you separate the insurance from the savings element, you now have a lot more control. You can invest your money somewhere else besides with that insurance company. Now, an argument the permanent guys made was, well, most Americans are not trained. And I'll take that argument. I don't think that argument works anymore. I do agree this is a good argument. You have more control over your investment program. I don't think this is a good counter argument to that Americans don't know what they're doing, because with the mutual fund industry and now exchange traded funds, it's quite easy for the most unknowledgeable investor to just go to a Vanguard and stick all the money into one of their target funds and forget about it. It's very simple. All you have to do with target funds at Vanguard is just figure out what year you plan to retire. If that's 2050, then you just buy their 2050 fund. So I think the investment industry has gotten around this counter argument to argument 4. So I think argument 4 does have some strength to it. We'll talk a little bit at the end what the variable products have done to this argument, but I do think it does have some favorableness to it. Number 6 is actually my biggest argument, the one I like the best, and that is it's simpler. And there's really 2 arguments here, so I would actually break these out. Make sure you make both of these arguments. Buying term and investing the difference, it's much easier, because when you buy term, about all you care about is how much is the premium. If one company charges you $35 a month and another one charges you $50 a month, both for a $250,000 policy, then buy the policy that's $35 a month. As long as the insurance company is a viable, going concern, then pay the lower premium. And that's the other aspect here, is with level term, it's much easier to comparison shop. The premium's the only thing you have to care about. Remember, with permanent insurance, you have the premium, the cost of insurance, but you also have to look at how much am I making on the savings element. And what if I want to do a policy loan? And what if they're going to pay dividends? There's so many other things to look at. With level term, you just say, what's the premium? I'll pay the lowest premium I can from a reputable company. And it's easy for me to compare 5 or 6 or 7 companies and get the best deal. So I really love number 6 as an argument. Number 7, this one, both sides have an argument here. So the buy term invest the difference, they say, hey, you can withdraw funds from your investment program and it won't affect your insurance coverage. Now, if you borrow from your insurance, that's not good, because if you need that insurance, you're borrowing against it, you're actually reducing how much insurance you have. That's true, but if you're borrowing your savings element, if you die, you're going to get most of it back. Essentially, they'll net it out and just forgive the loan. So you're kind of getting it back because you don't have to pay the loan. It gets a little complicated here. I do agree that for most people, it seems simpler to get money out of an investment program. You just call your broker or go online to Vanguard.com and just say you want to sell some shares. The problem I have with this argument is that when you sell investments, you often will create tax issues, especially if you buy term and invest the difference in a Roth IRA or a traditional IRA. It is very difficult to get money out of these tax sheltered securities. So we'll talk about with life insurance. There's a way to life insurance you can actually borrow against a product that I think on this particular case, I think it's actually more tax efficient to get money out of your permanent life insurance than it is to try to sell investments to fund a cash need. Number 8, insurance companies pay very low rates. This was very true when this was written. Whole life insurance in the 1970s paid very uncompetitive rates, very low rates, especially relative to the high interest rate environment. But remember that universal life was created to create much more competitive rates. So that is not as true as much. And it also tends to be a higher quality investment. We'll talk about that more when we talk about permanent, because there's a counter argument to that. So on all of these, there's an argument, a counter argument, and then a counter argument to the counter argument. But I don't think this is as true as much, especially now with universal life and variable universal life. You can essentially invest that cash savings element in whatever asset you want to. And then number 9, if you insured your entire life, you're buying insurance for those years where you have no human capital. And they don't use the word human capital here, but they do say you're buying insurance when you're not making any income. So they imply human capital here. And then you're essentially paying for insurance when it's the most expensive. So it's true, you have the savings element and you have the insurance element, but that insurance element, the premiums are going up every year. It's just you don't notice it, because essentially you're paying part of the premium with your cash value as you get into your 60s and 70s. Now, one argument they do not have here that I would put, especially on this more control over the investment program, is when you buy permanent insurance and you combine the savings and insurance element. Remember, insurance companies are very expensive. The fees they charge are always much higher than the investment world. So when you do a variable product or variable universal life product, what you're going to discover is you're going to pay fees for the mutual fund, and you'll have fees on top of that for the insurance companies. So it's practically impossible, except for the tax advantages. And tax advantages are a big deal for life insurance. Except for those tax advantages, it's very hard for them to compete on the investment side. Now let's see what did the guy who wrote the book on permanent or on insurance say about permanent insurance. And his first argument is, yeah, with that old whole life insurance, yeah, we're paying lower rates, but these were low risk investments. And I've had 2 arguments against this. One of them is on this page and one of them is not. The first one is if you're 22, 23 years old, you don't want to have 100% of your money essentially into a low risk, high quality bond, which is what whole life insurance essentially did. They were buying high quality corporate bonds, taking it off a spread, and then paying the policyholder the difference. Young people probably should have most of their money in stocks, as you wrote about in your paper one. Young people, because they have a lot of human capital, which is very bond-like, they really don't want to buy a permanent insurance policy that's also very bond-like. They have room to take the risk of the stock market. The other argument on this is it's that term low risk. Remember, with life insurance, when you buy a life insurance product, it's low risk in the standpoint that it's guaranteed. They're buying low risk investments, but it's not low risk in the standpoint that you have exposure to that life insurance company. I would really get that into your answer. If that life insurance company goes insolvent, all of your money is with that company. That's very different than a mutual fund. If a mutual fund company goes insolvent, the mutual fund assets are segregated assets. They do not belong to the mutual fund company. They're protected from the mutual fund company's creditors. So if UTSA or Fidelity or Vanguard were to go insolvent, the companies themselves, the management firms, their mutual funds would not be harmed in any way. Those are separate assets. They're protected. But if you buy life insurance, if the life insurance company goes under, you are exposed to that company. Now, you do have some protection because states do provide FDIC-like insurance, but it only goes up to maybe $100,000. And if you have more insurance than that and your company goes under, you do have exposure. So it's low risk in the standpoint that what the life insurance company is investing is low risk, but if the life insurance company itself is risky, this can be a really high risk. And you think about it, that's the worst possible combination. They're paying you very low rates, even though you have large exposure to the life insurance company. The second issue is you may need insurance later in your life. So if you live too long and you can't get insurance later in your life, then what are you going to do? So that's the example I will give with my parents. Well, later we'll walk through this. Is my dad got his pension, but he did not get the survivorship benefits of it, so that if he passes away before my mom would continue to get the benefit. He got a single life pension plan, and then they took the extra money for doing that and they bought a life insurance policy. So there are times where people do need life insurance at the end of their life. Now, obviously, if you do the buy term and invest the difference that you have invested should be large enough to make up that you don't need life insurance later in life because you have all these assets. So you can make it both arguments. There are some really strong arguments, especially for wealthy individuals, to use life insurance, if you set it up correctly, to use life insurance to help pay all of those estate taxes. Not just estate taxes, but just all the taxes when a person dies, including the income tax, which can be really quite significant. The third argument we've already hinted at. The guy in this book said most individuals cannot invest their own money. They're not professionals. They need to hire professionals. I think that argument is completely dead today because there are so many easy to use, inexpensive investment firms. You can go on the Vanguard.com. They'll walk you through the entire process. You can even send them money online. Very, very simple, very straightforward. With the lifestyle funds I mentioned, not only is it easy to use their services, but they even tell you exactly what product to buy. If you don't want to think about it, just pick the year you're retiring and buy that fund. Very easy. All right, let's talk about liquidity, number 4. I do think this is the stronger argument for permanent insurance. I'm not sure it's easier to borrow from your policy. So if you have a $50,000 in cash value saved up, it may not be that you have to call the company and walk through the process, and it may take a few days. So it might actually be longer because they may actually mail you a check that could take 3 or 4 days. Whereas your mutual fund might be set up so in 2 or 3 days they'll have the cash sitting in your checking account electronically. It's possible life insurance companies provide policy loans electronically now. But I think the big deal is you don't have the tax consequences. If you take out a policy loan on your life insurance, there's no taxes at all. And if you pay it back, there's no taxes. So it can be entirely a tax-free transaction. Here's the strongest. Number 6. So let's set up before I talk about number 5. Number 3, or I'm sorry, number 2, if you live too long. And number 6, you may need life insurance past the time you have human capital. I would put those two together. I don't know why in this textbook he separated those, but I would put number 2 and number 6 together. I really talk about them at the same time. And if one did not invest a difference, they may be in a lot of trouble. They may not have the assets they need to pay their estate taxes or to help with medical costs because they bought term and then spent the difference. So number 2 and number 6 we covered. So let's talk about number 5. Number 5 is far and away my favorite one for permanent insurance, and that is it's a form of forced savings. So individuals are not rational economic decision makers. They're not disciplined. Permanent insurance, now here you need to make it in your notes. We're really talking about whole life insurance. Remember, when we stick that word universal life, we're now getting away from this forced savings, and we're telling people you don't have to pay for the savings element. You only have to pay the cost of insurance. So there really isn't a forced savings. I still think with universal life, my parents bought a universal life, and they just paid the premium every month without thinking about it. So it was a quasi-forced savings, but they did not have to do that. They could have, if they wanted to, if they had short of cash one month, they could have just paid the cost of insurance. But I do think there is something here. I do know of several people that their permanent life insurance is about the only savings they do have, and it was this forced savings that caused them to do that. Now, the mutual fund industry, with electronic transfers, taking money out of your account automatically, there are ways mutual fund companies are trying to get it so forced savings is easier. And on the other side, with the life insurance industry moving to unbundled products, they're actually reducing the forced savings argument. So it's going in both directions. So the forced savings argument is not as strong. I still think it's the strongest one just because I know certain individuals, their life insurance, it's a bill, they pay it. They don't look at what piece they have to pay and don't pay. And for some of them, that's very fortuitous. Now, I do want to talk about my parents' policy. I think I will save that until after we finish annuities because I don't want to. It won't be on the test. I want to make sure we get through all the test material. But I do want to bring it up just so you can see how horrible these products could be and these permanent insurance products can be and the issues you have to deal with. I'll just real quickly say the universal life policy I have on my parents, the one I'm paying for right now, my parents purchased it, but I've taken over it. My father's health is not real strong, but this policy goes away if he makes it to 95. He's 89. And so we have this horrible thing to think about. Do we keep paying these extremely high premiums thinking that his life expectancy is very short, or do we cancel the policy and then he passes away a week later, and now my mom really needed that money for her retirement? What do we do? These are excruciating decisions that have to make as a family, where you essentially, if the savings element runs out, and that's why I love whole life so much better. With whole life, your premium is fixed forever. You'd never have to worry about it. But with these unbundled products, if for some reason what you're earning on the cash value is not sufficient, then the cash value can go completely away. They'll spend all of it covering your extra premiums. The cost of insurance rises, and suddenly you have no cash savings element, no cash value, no savings element, and suddenly you have these premiums that are going up. For my parents, their premiums are 5 times larger than what they initially started paying. And these are horrible decisions I have to make. I'd like my dad to live as long as possible, but at the same time, we're trying to figure out what to do with this life insurance. If I knew exactly when my dad was going to die, that would let me know exactly what to do with this policy. I think what I'll do is I'll save this when we talk about viaticals later in the class. It's a good place to talk about there, where I think you'll see the challenge we have this, and what you have to do sometime with permanent insurance to actually sell it to somebody else to get as whatever cash out of it that you can. That's a long story to say that this is the strongest argument for permanent, but it has a lot of problems with it now because of how the life insurance industry is changing. So there's your arguments. Combine them in a way that makes sense to you. Get it logical, get it organized. But part of your answer will be these graphs. I have 4 graphs in here. You need to have at least 2 graphs to show that you understand. So let's explain this graph. Make sure you're taking really good notes, because these graphs are not explained anywhere in the notes, class notes. So the first thing is to understand the axis. So the y-axis is dollar amounts. The x-axis is age. All right, I didn't mark the axis, but you need to mark your axis. So the y-axis is dollar amounts. The x-axis is age, or attained age. And really what the y-axis is measuring is 2 things, or really 1 thing. If you were to buy term insurance, which is in the orange, or whole life insurance. I did this with whole life. I did this with actual numbers. So I actually went out to an insurance company's webpage and I priced the policy. No, actually I did this using the mortality tables that we'll use later. I tried to find an insurance company, but I couldn't get exact apples to apples, and I wanted to use 30-year, and I couldn't find a company that would give me good 30-year premiums. So actually I used exactly what we'll do when we price insurance. I used the mortality table, and I priced the policy off the mortality table. So it's a 1980 table. So I forgot about that. I might have said that last class, so hopefully I'll remember. I changed that. I haven't always done it that way. The first time I set this up, I had a friend who was going into the military, and he had a decision to make between whole life. In his case, it was actually whole life and term, level term. And I built these charts for him. Now, it wasn't exactly apples to apples, because the company giving him the whole life was not the same company where we were pricing the term. So we probably should have done it with the same life insurance company. But anyway, I built it for him the first time. And then this last time, I've used the mortality tables that are found that we'll use when we price the products later in the class. So we're looking at what happens when a person dies if they had 30-year term and they invested a difference. That's really critical, right? If they did not invest a difference, then you'll get a very different line. Or if they bought whole life. And what this is showing is the proceeds from the death if you have whole life, or the proceeds at death if you have 30-year term, plus what you earned on the invested difference. So the whole life, you notice, is just 1 line all the way across. Because if you die here, you get $250,000. Part of that $250,000 is the insurance company paying you a claim. The rest of it is the insurance company actually giving you your cash value. So essentially, with whole life insurance, the insurance company is insuring most of it early on, but as your cash value grows, you're insuring yourself more and more and more. And when you get to age 99, essentially the entire cash value is all your money. If you die here, you're essentially just getting your cash value back. But it's a flat line. So whole life is easy. If you buy $250,000 of whole life, if you die, you get $250,000. So that's pretty easy to understand. So let's understand the 30-year term. So the way I did the 30-year term is if you die during the first 30 years, you'll get $250,000 just like the whole life. But you'll also get whatever portfolio you invest that. And here I assume you make 3%. So if you invest a difference, because term insurance is cheaper, you invest a difference, and you invest it at 3%, here's the portfolio you'll have. So as you age, so let's say you die at age 51, you'll get the $250,000 plus about $60,000 of invested money, because you died and your portfolio grew at 3%. So you'll get 250 plus 60. Then you keep moving along, Then you come to year 30. Where at year 30, if you haven't died, but you die the next year, with the term insurance, all you're going to get is the portfolio, because you no longer have insurance. And it drops off a bunch. Instead of getting, if you had whole life, if you died at age 57, you would have gotten $250,000. with the whole life, but with the level term, because you no longer have level term, right? It's expired. You had your 30 years. Now all you're going to get is $100,000. So you can see from age 54, I think I started this at 25. So from age 25 through about 77, the whole life pays more. All other times, the term pays more because you have the portfolio, or out here, the term, you don't have any life insurance, but your portfolio, even growing at 3%, actually gets bigger than what you would have gotten. So the whole life makes sense between ages 55 and about 78. The term plus investing the difference works better in every other year. It's extremely important that you can explain that, what this orange line is. And what I did is, once the 30-year level term stopped, I didn't just invest the difference, I invested the entire whole life premium now, because I don't have to pay anything for term insurance anymore. So here I might be, the whole life might be $200 a month, and the term might be $50 a month. So here I'm investing $150 a month at 3%. So if the term is the term is 50, whole life is 200. Here I'll be investing 150, but here I'll be investing $200 a month, because I don't have to pay even the $50 for the term insurance. Now this is if you earn 3%. So the key here is, how much will you earn on this money if you invested it yourself? 3% should be fairly easy to achieve. You assume the stock market will average probably 6 to 9%. And bonds, you can bond mutual funds that are paying 2.5%, 3%. So a combination of stocks and bonds should get you an easy 3%. What if you could earn 4%? Well, you notice if you can earn 4%, all it does is it shifts the orange line up. It doesn't have any impact on the blue line, but it shifts the orange line up. So remember, in the previous one, the difference was between 55 and about 78, where you were better off with whole life. Here, if you can make 4%, the difference is from 55 to about 70. So there's about 8 years less advantage of the whole life. So here, yeah, you could die during these years, but if you die during these years, your beneficiaries will get less, but it's not quite as bad. It's only about, well, this is 50,000, so maybe it's 150,000. I should have put more markers over there. But it is, trust me, it doesn't fall as steeply. What if you could earn 6%? Well, you can see it's 6%, and again, it's hard to tell the numbers because the scale is so wide. But here you're going from like 55 to 60. There's only a few years. You're really, if you can make 6%, you're probably far better off buying term and investing the difference versus buying the whole life. Especially if you can earn the 6% in a Roth IRA, so it's tax-free, and it's tax-free forever. Even after you retire, it's tax-free. That gives you something that's essentially just as good as the life insurance, just as good as the tax benefit. But if you make it past age 61 or 62, you're going to do a whole lot better investing this money yourself. Now, obviously, it's going to be more volatile. You have the COVID-19, your portfolio would have dropped about a third, but then it would have bounced back up, but it will be more volatile. So this is just showing over time, but the real path might be quite volatile. And then I did the break even. And what I meant by break even is that the term life plus investing the difference was never worse than the whole life. So if you can make 8.58%, you would obviously just buy the term and invest the difference, because you're making more. You would never be worse off. Now 8.58 is a very high rate. So you're probably going to be more in the 4 to 6% range. Even in the 4 to 6% range, buying term and investing the difference makes sense for most people if you truly invest the difference. If you're disciplined and invest the difference, you'll only be slightly worse off than whole life in a few years, and in most years you'll be far better off buying term and investing the difference. Especially if after age 55 you're getting close to retirement. So if you were to die here, you really wouldn't need that much money. You just need some money to pay your beneficiaries, to help them with estate taxes, and maybe give them a little inheritance. You may not care that it's only $175,000 instead of $250,000. So if you get that 30-year term getting pretty close to your retirement, you may be set. You may be fine. So the key is, make sure you understand what the y-axis is doing, what the x-axis is doing, and then put at least two of them in there and draw it very precisely. I wish, it'd almost be good. If I remember later in the class, I'll actually show you how I built these charts using the mortality table and see if you can actually create it yourself. It's good practice to understand. We'll learn right now. It probably seems like, wow, that's pretty crazy stuff. But you'll learn enough in this class that you can actually do this type of insurance pricing, and it will not be very, very difficult at all. I don't use the more advanced formulas because I just don't want you to have to memorize formulas that are a little cumbersome. But we'll do the exact same thing. It's just that we'll do it using fewer years. When it gets out to 30, 40 years, it can get kind of difficult, but 2 or 3 years, it's not difficult to do these. These I did in Excel, and in Excel, it's pretty easy to do these in Excel. Even if it's 50 years or 70 years, in this case 75 years, I went out to year 100. I actually changed the scale on this. You notice I stopped at age 68 just because you wouldn't be able to see anything at all. All right, so think about your exam answer for term versus perm. You have the several reasons to buy term. You go through each one of those, reorganize them. You have the several reasons to buy permanent. Reorganize them, like putting 2 and 6 together. And then you'll end it up at the end with these graphs that say the bottom line is between term and investing the difference in whole life, which is really what we're just talking about here. Between those two, it really comes down to what you think you can invest in difference at. So with whole life, it's going to be a pretty low rate because they're going to buy corporate bonds and charge a spread over top of that. So you probably are only making about 3 or 4% on the cash value with whole life, but probably not even 3% today with interest rates so low. So with term and investing the difference, if you can make 4, 5, 6%, you're probably much better off buying a term. And I think for most people, buying term is the better product. All right, so we'll get into annuities. There are a few issues I want to cover on this. Well, one last thing that you might add to your answer, I think, make it pretty powerful, is we're talking about whole life here. What if we talked about universal life? Now, you noticed in paper 1, when they did that objective function for human capital paper, on the human capital paper, they said we need to do more research at looking at other types of life insurance. And definitely, this whole picture changes quite dramatically if you have other types of life insurance. So this is a very simplistic one, just looking at whole life. I actually think whole life is a great product. I wish my parents had bought whole life instead of universal life. I do think whole life has a role, and I actually think some people probably, a lot of people should maybe have at least $100,000 in whole life just to have something there, just because you never know what's going to happen, and it's somewhat nice to have those proceeds if someone dies unexpectedly, even if they die at 80 or 85 or 90, just because you just really don't know what things you have to cover in the future. So, but make it clear in your answer, we're talking specifically about whole life insurance, which remember is a bundled product. It is not universal life. You have to pay the entire premium. You have to keep the savings element funded versus buying level term and investing the difference. All right, so this would be a good time. We're about 2/3 through the class. If you want to hit pause and go get something to eat or drink, and then I'll start in on annuities. All right, so annuities. I'm on page 27 of the class notes. You're talking about annuities in paper 1 on that 3rd and 4th articles. There you're talking very specifically about a very particular type of annuity, which is a payout annuity. So we have to distinguish between accumulation type products and payout products. There are 3 industries in the private sector that provide annuities: banks, investment companies, and life insurance companies. Extremely important to understand that banks and investment companies only offer annuities for the accumulation period. That's when you're saving up. So you're investing over time. The articles you're doing for paper 1 are talking entirely about payout annuities. They are not talking about accumulation. So accumulation annuities really are not annuities. What they are is savings accounts, so you build up capital so that you can fund an annuity. Remember, the typical definition of an annuity that you saw in your accounting classes is a fixed dollar amount that you get monthly for the rest of your life, or for 10 years or 20 years. you might remember the present value interest factor of annuity. So it's assuming, hey, if I got $500 a month for 10 years with 3% interest, what would that be worth today? So that's an accumulation product. You might have the future value interest factor of annuity, which is saying, hey, if I invest $500 a month at 4% over the next 30 years, how much will I have when I retire? So these are accumulation products. Most banks and investment companies and life insurance companies provide tax-sheltered annuities, Roth IRAs, traditional IRAs. We'll talk about those a little bit later. Most companies, all these companies offer. You can buy an IRA from a bank, from an investment company, and from a life insurance company. So the key for life insurance companies is that they're the only ones that can provide in the private sector provide the payout annuities. Now, Social Security and corporate pension plans are payout annuities. So you can get them from other places, but you don't get them from banks and investment companies. Banks and investment companies do not provide life contingent. See this term down here, life contingent products. They do not provide products that are contingent on when do you die. Only the life insurance industry can provide you a product where they say we will pay you a certain amount every year until you die, or every month until you die. So that is a powerful thing. And you remember when you're working on paper one, the annuity puzzle, these are really quite economically advantageous products. Now the guy I talked to, remember the guy I told you that was giving me retirement advice and offered me equity-linked annuities, he really badmouthed these payout products. He said you should never buy an immediate annuity. I disagree with him on that, but I didn't argue with him. They do have a great benefit. Now you notice in paper one, one of the negatives of this product is when interest rates are really low, you don't get nearly as much as when interest rates are high, but that's also true for other investments. When interest rates are low, stocks tend to give you a lower payout as well. So it's all related. So keep this in mind as two separate products. We're incorrectly using the word annuity for the accumulation products. They're really just retirement accounts. They're just really savings accounts. But we use the word annuity, we're deferred annuities for those, where they're really not annuities, they're just saving products. So we'll talk quite a bit about payout products. There are some payout products that I really love called longevity annuities that I will introduce you to, and you'll see why I like them so much. So it's an interesting industry. Everybody hears the word annuity. Usually when you hear the word annuities, you're thinking the accumulation phase. But your paper one is very focused on the payout phase. Now, why do people need these things? So I've got a short list here, but you will go into a much longer list on your paper one. So don't reference this for paper one. Everything here is more than covered in those two articles for paper one on annuities. But why do we need annuities? People are living longer. People are retiring earlier. Or they desire to retire earlier. I retired at age 46, and I now just teach part-time just for the fun of it. But people are retiring at 55 or 62. There's some countries like France that have very early retirement ages, like 55, and it's causing them major problems because they can't afford to pay these pension plans. But if they ever change the rules and try to push back retirement ages, literally cars are turned over and set on fire in the streets. People get really upset. The other thing you saw very, very strongly discussed in the paper one was the baby boomers. More and more people are retiring. Again, this is going to put tremendous stress on retirement systems. And in particular, Social Security is having problems. You're going to see, we'll discuss this more when we talk about healthcare, how Medicare and Medicaid especially, and especially Medicare, are going to be really driven to insolvency because of baby boomers. I want to touch this one issue here about people living longer, and there's a way I want to show it. Hopefully y'all won't find this troublesome. I think it's kind of hilarious. I saw this in a conference, and to me it was pretty eye-opening. I did it a little differently, but I want to show you. So I want to show you this picture for people living longer. So at the conference, he was making the point how much longer people are living. And he did this famous painting. I talked to one of my life insurance classes about this, and they had never heard of this painting. It's Whistler's Mother. My understanding of the story, you can look it up on Google or Wikipedia, is that Whistler is a famous American artist, and he had a portrait he was supposed to do. He was all set up, and the lady who was supposed to come for the portrait did not show up for some reason. I can't remember the reason. And so Whistler asked his mom to sit in, and Whistler's mother was 67 years old when she sat for it. My guess, if you're looking at the picture, she looks much older than 67 years old. And so what this guy did is he compared Whistler's mother at 67 to Sophia Loren at age 77. And you can talk about people. Today we have all kinds of things, and I don't know if Sophia Loren did any of those things, Botox kind of things. She's a very youthful-looking 77-year-old. No matter what actors have to do and actresses have to do, but definitely 67 is not as old as it used to be. That used to be our life expectancy, but now women are living well into their 80s and vibrant and real active. But I went even further, and I did Raquel Welch at age 74. I have not seen Raquel Welch in a few years, but this is a picture of her at age 74. Does maybe touched up picture? It's possible. Maybe that's what Whistler should have done. Maybe he should have touched the picture of his mother. So maybe there's an exaggeration here, but I just want to make the point. You think about Raquel Welch. I've seen her in TV shows when she was well into her 60s. Very active, doing a lot of exercise videos. So we're living longer, and you can definitely tell. Some of y'all may have noticed this. One thing I noticed, if you go back to TV programs back in the 40s and 50s, or maybe 50s when TV started, I like to watch the TV program What's My Line. And they have people come in, and they look like they're in their 70s, 75, 78, and they're in their 50s, and it's just shocking. So that's the point. People are living much longer, and it's probably going to get better. There's actually there are many research scientists out there who say there's no reason for the human body to age. It's not just passage of time. You think about your car ages and breaks down and things break, but your car is not a living organism. It doesn't replicate. It doesn't regrow cells. And so there are some scientists who think they might find the fountain of youth, that we might actually be able to live to 150, 200 years old. As I always joke, they'll probably find that pill when I'm 97, and so I can live 60 years in a 97-year-old body. Who knows? But life expectancy is definitely changing. And now it's slowed down the last several years. We'll talk about that later when we look at some articles because of opioid abuse in the United States. There is a lot to this. One of the reasons life expectancy has increased is because of infant mortality has fallen so much. So that's probably the biggest reason. So many people were dying as infants back 100 years ago, and that rate has dropped dramatically, and so that greatly increases the life expectancy. But also better diet, better health care, and we'll talk about this more when we talk about health care as well. Better health care, better procedures, better technology. So to me, it's an interesting issue, but maybe give you just a little bit of extra fodder for paper one. So what are the solutions? So one thing we can do is push retirement back later. I actually think for Social Security and Medicare, that is the only solution that can work. Congress doesn't want to address it because senior citizens vote. They probably can't do anything for people in their 50s and 60s because they'll come out in force. But probably for those of you in your 20s, someone's going to have to eventually say you can't retire until you're 75. When the retirement age was fixed at 65, there's some history on that, and it goes back many, many, many decades. And when 65 was set as retirement age, we were not living to 65. The life expectancy was less than 65. And now that we're living, the life expectancy is 85, we still have that 65 in our mind that we can somehow, live it, go to school until we're 23, 24, work until we're 55, and then be retired until we're 95. So we'll spend over 2/3 of our life as dependents, living off of our parents or living off of our savings, and only 1/3 of our life working as productive adults. That doesn't make a lot of sense. So we're probably going, if we're going to live to 85, 90, 95, we're probably going to have to work until 70, 75. Now, there is an in-between on this, and that's partial retirement, which people going, instead of working 40 hours a week, they work 10 hours a week, and that can help tremendously. Just any income you can get at all makes a huge difference. Social Security, the problem with that is that the proportions are getting worse because of the baby boomers. So that's one thing you saw in paper 1. I think it was in the 4th argument where they talked about the dependency ratio. How many people, workers, are having the funds? So it's their children plus their parents. And there's just not enough workers for all these people that are dependents. Annuities, you can certainly do annuities and pull the risk, and we'll talk about that. That's what you're talking about in paper 1. But for some reason people don't buy those, so you'll talk about that annuity puzzle. I do think they have a good role to play. I will probably never buy an immediate annuity, but only because between my pension plan, my Social Security, and my second pension plan from UTSA, I'm making 5 times more than my living expenses, so I don't see any reason to produce more of that, and I just want to invest my money for my heirs. My heirs are essentially my charities and my brothers. So I probably will not, but I think for a lot of people it makes a lot of sense to buy an annuity. The other thing you can do is just build the largest portfolio you can and just hope you have enough. Put it in the capital markets, bet on the markets, hope you don't have a major market crash like Japan did back in 1989 or the US did during the Great Depression, and then hope you don't live so long that you spend it all before you die. And the last one is just don't do anything. Be poor, and the government will provide welfare in addition to Social Security. I think you look at the savings, and y'all saw that in some of the articles that Americans just don't have enough saved up. There's a lot of Americans that they're in their 50s, even their 60s, and only have about $50,000 saved up, if even that. There's just no way they're going to be ready for retirement, and Social Security is probably all they're going to get. So Social Security is skewed toward lower income. So for higher income, they're not getting as much. One way, if you're higher income, one way to control this is to take your Social Security later. So I'll probably wait until I'm 70 to take my Social Security, or even 72, just because the amounts go up tremendously, assuming I'm very healthy. If I'm not healthy, then I'll take it immediately. I could even take Social Security now if I wanted to. So if I got diagnosed with some horrible disease, I would definitely take my pension plan from UTSA and take my Social Security. But Social Security is skewed toward the lower income. Now, I've asked actuaries if this is really true, because we know lower income people don't live as long as higher income people. So what I'd like to actually see here, I've seen a couple articles, but I just, they're not reliable sources that I saw. So if you were to adjust Social Security for life expectancy, how much is lower income really getting extra income off of Social Security versus high income? So it's hard to say. Now, they may skew this next election. There's been several in the Democratic Party talking about on Social Security there's a cap to how much you have to pay the tax on. And the reason they do that is because there's a cap on how much income you can get. And there's some people talking about taking that cap off the Social Security tax, but not paying richer people more money. That would essentially just be an extra tax on the wealthy, because they wouldn't accrue any extra benefits for Social Security, but they would be paying a significant amount of extra tax. Remember, the Social Security tax is what? About 13%. So if the cap is $125,000, I forget what it is, don't quote me on that, and they make $500,000, essentially they're going to see an extra 13% tax on that $375,000. So it's not immaterial. So that's something definitely to watch. Social Security could become much more skewed toward the poor. The other problem with Social Security is it is a pay-as-you-go program. The government is not really setting aside money. It is true Social Security has a little bit of a surplus, but it's not all that large, and that surplus will be dissipating pretty rapidly over the next decade or two. It was interesting to me. I did a paper on Social Security, and I was reading some of the notes from Franklin Delano Roosevelt, who's the one who set up Social Security. And one of the last things they had in that book was him talking about Social Security and him saying, do not set it up as pay-as-you-go. The government needs to set aside the money like any insurance company would. And he said, if you don't do that, and it was just amazing to me, he said, if you don't do this, Social Security will be bankrupt by 1980. And boy, I don't know what math he was using or if it was just a lucky guess, but in 1980, Social Security was in serious trouble. And Ronald Reagan and Tip O'Neill, a Republican president and a Democrat Speaker of the House, they got together and they significantly increased the Social Security tax to try to get the program back into balance. But it's still not in balance forever. We're paying an enormous amount into Social Security, and there's still not enough money to pay you guys Social Security, so something's got to give. My guess is they're going to have to push back retirement ages. Then you have qualified pension plans and profit sharing plans. You already saw that in paper 1. You saw how much benefit plans are declining. I'll show you this here next slide. More and more firms are shifting to 401k plans. There's two problems with that. First of all, you're relying on employees to invest smartly, but we know what employers do is they buy high and sell low. They buy whatever has been going up the most recently, and they sell whatever is down, which is the exact opposite. I ran UTSA's 401k plan. Anytime the statements went out, I would look at the statements, and whatever an option had the highest return, I would call that manager and tell them, you will be getting a large cash inflow tomorrow. And I just knew it because when employees got their statement, they would immediately move 100% of their 401k to whatever option had the highest return. It's just very bad investing. And the second problem with 401k plans is the same problem we saw with buying term and investing. The difference is employees don't invest, or if they do, they raid their 401k plans. I helped a lady at UTSA, a good friend of mine. She did all my insurance for me, helped me with my auto and homeowners insurance, making sure I had it set up correctly. And I helped her with her 401k plan. She had been at UTSA for years. She should have had $200,000-$300,000 in her 401k plan. She had $40,000 in that, and that's because she had a son that had some issues, and she was rating that plan for her son. She was taking money out of it to buy a car, to refurbish her house. She just did not have much. Fortunately for her, she had a very good defined benefit plan from UTSA. That's all she has right now. That thing's probably worth $300,000 in present value dollar terms. That was it. That was her entire retirement. Now she'll get Social Security as well, and that will definitely help. Between those two, it's almost enough to fund her retirement. She'll just have to cut back on expenses. I hate talking to her because every time I do, she just spent a whole lot of money on her house or on a new car or something. And she's always embarrassed to tell me. But you have a lot of that in paper 1. But here's a chart that shows this defined benefit plans, pension plans. They're down. This chart you might have a similar chart like this in paper 1. This is a more current one. It's in the class notes as well. Defined contribution are going up, and then firms that have both. UTSA used to be in this both category. I did my best to have UTSA keep its pension plan. I've worked so hard at it, but I just could not convince the CEO to keep the pension plan, and instead they had a defined contribution plan. They just doubled up on it and gave much higher contributions on the defined contribution plan, and they shut down their pension plan. And they still have it, just that employees are not gaining any new benefits out of it. So so personal savings, I have a little bit of redundancy in these notes that I don't like, so sorry about that. So personal savings, we already talked about that. So let's talk about life insurance annuities as a unique product. Pension plans, Social Security do this as well, right? They pay you until you die. But those are products that employers don't offer as much, or Social Security doesn't really pay you enough to live off of, so you have to add to it. So would you want to enhance that with a life insurance annuity? Gives you protection from living too long, to protection from outliving your retirement resources. So we'll stop it there. We've gone about an hour. And just back in my notes, let me just real quickly tell you, I don't like the way I did the notes here. So we were talking under solutions. I mentioned things, and then after solutions, I then talk about products. And so there's some overlap on that. So sorry about that. I'd forgotten that I had done that. So there's a little overlap on those two. So I kind of talked about the same thing twice. But anyway, that gives us a good setup when we start talking about annuities, tax consequences, the different types of annuities, and then we'll get real specifically when we talk about the equity-linked annuity.